I'm Charlotte McLeod with investingnews.com, and here today with me is Gerardo Del Real, co-owner at Digest Publishing. Thank you so much for joining me. Great to have you.
Charlotte, thank you for having me back. A couple of years in a row now.
Yeah, and I was looking back at our previous interview, and I realized we haven't actually spoken for the last year, so we have a lot to catch up on. And I wanted to start by asking you if you can catch me up on just any key changes you've made to your portfolio, or maybe you haven't, maybe it stayed mostly the same.
Man, that's a really loaded question. Let me explain to you why. I know it's a great question, by the way. There's just a lot of layers to it. So I think last year when we were here, we joked on air that my favorite commodities last year were lithium and uranium, right? And true to form, I had a phenomenal year with the lithium and the uranium names. And it speaks to your influence and the INN influence that this year we actually have lithium and uranium companies amongst the gold crowd, right? So I think people might have watched your interview and took a hint. But no, look, jokes aside, I think the lithium space, let's start there, is undergoing a consolidation that's really healthy. The spot price shot from 20,000 to 80,000 in really short order. It's now pulled back from 80,000 to 20,000. And so a lot of the equities, one example, last year my favorite equity was Patriot Battery Metals, which is up 100% from last year. This time last year, it's up 100%. But it was up 300% up until recently before a recent pullback. So I think the pullbacks have been healthy. I think the consolidation is nearing a bottom. I think this is an excellent time for contrarians that missed the first run up in lithium to actually gain exposure to the next leg up, because I think it's about to turn. So that's the lithium part of it. So absolutely still love lithium. Uranium was something that, luckily we caught really early, and we were able to position subscribers, and I was able to position my portfolio ahead of that initial leg up. And I think now we're in the midst of the second leg up. We just hit a 15-year high in the uranium spot price. We have funds now dedicated, the Sprat Fund just dedicated exclusively to allocating capital to storing physical uranium. And the utilities, which are the single largest consumer of uranium, still have it rolled over the new contracts. And so when they come into the market, the $75 spot price is going to go triple digits in a hurry. So I would encourage anyone that's listening to really do their homework in the lithium space and the uranium space if they haven't yet done so. Here's the big change to my portfolio. I'm actually excited about gold this year, folks. And so I know last year I said it wasn't time yet, and, not to, pound the table on that, but it wasn't time yet. I actually think it's time now. It's really time to get in there and look at these beaten down producers, developers, and explorers and pick the creme de la creme, whatever your favorite jurisdiction is, whatever your favorite management team is, and start adding exposure, because I think we're on the verge of a breakout in the gold price that's going to lead to new all-time highs. And the reason I say that is because even the most ardent of gold bugs, they're fed up. They can't figure out why, with all of the turmoil going on around the world, gold hasn't been able to break out to new highs. I think we're on the verge of that.
Okay. Many points to follow up on here. So last year, I will say I was caught off guard by talking about lithium, and uranium fine, but lithium, I was not ready for that at this conference. So this year, I'm a little bit more prepared to talk about lithium. So we'll see how this goes. So you talked a little bit about what's going on in the market, and I wondered if you could kind of situate us a little bit more, because you mentioned this consolidation that's happening, but we know that long term, there's supposed to be this huge demand for electric vehicles. So situate us a little bit more in the market.
I would say this. Listen, I think the run up from that 20,000 to that 80,000 spot price was in large fact due to China misallocating how much they were going to need. And there's a thing that happens with critical metals where you get to a point where it's not what you pay for the supply, it's having the supply. And China got in a position where they had the capacity to produce, these batteries, but they didn't have the input. They didn't have the lithium. And at that point, you have to feed the factory and you have to feed the customer base. And they were willing to pay any price. And I think that's why you got that rise exponential from 20 to 80. I think that was overbought, but they didn't really have a choice. So this year, we're seeing the opposite happen. China actually has enough lithium, enough capacity. Their needs are met for the time being, but the West is now making the exact same mistake, whether it's, the US, whether it's Canada. And I think that's about to turn, because you're seeing the Toyotas of the world saying they're expediting and expanding their factory. They're investing $8 billion. The Inflation Reduction Act, which regardless of how you feel about politics and the administration and the comically named legislation, right? Because it's a funny name. You print money to lower inflation, right? But there's some really good critical minerals legislation in there that provides tax incentives, big ones, for companies to build these gigafactories and these battery-making manufacturing facilities in North America. And those are starting. Quebec, where Patriot Battery Metals is located, is seeing an influx, billions of dollars of capital come into the region. So all of those factors tell me that the West is about to make the same mistake that China made last year, being let's build factories, let's expand capacity, let's be able to produce all of these batteries. That's all fine and great, but you still need the inputs. And without lithium, that doesn't happen. And I think we're about to see that ramp up in volatility once again.
All right. And, you know, for lithium, I think one of the first things people figure out when they start trying to understand the market is that there's not a single price, right? Lots of different types of prices going on. So we don't need to go into all the differences there, but I wondered if you could share any details on how investors can help sort this out and understand it.
Ultimately, I pride myself on being a simple guy, right? So the simplest way for me to determine what the real price in the market is to listen to the producers' conference calls. So like an Albemarle or a Pilbara. It's not hard because they disclose all of it. So if you listen to a quarterly earnings call, they'll tell you what their quarterly sales price was, the average price. That's the real market price. You know, the price that China reports is China's spot price, what they are able to source lithium for. That to me is irrelevant to the West. It's irrelevant to most of the world. That's what China is able to source its lithium for. And sometimes those numbers can be dubious, right? Whether it's their GDP numbers, whether it's the price that they're paying for, and they have an incentive to drive that price lower so they can continue to stockpile. And so I would encourage everyone to take 20 to 30 minutes of their time, pick their favorite producer, and see what they're actually selling their lithium for. And that's the right price. That's the true price, right?
Okay, yeah, no, that's a great tip. I think that's very helpful. So let's talk about your approach to the sector. So we know that you like Patriot Battery Metals. Talked a little bit about the ups and the downs there. Where else are you focusing? Because you mentioned this slump is perhaps a buying opportunity.
I really love the James Bay region in Quebec. I love the whole region. Now, I'll qualify that by saying I think out of the hundreds of explorers that have popped up, maybe 5 or 6 will succeed, right? And it's really important in this next leg up because I think now it's a stock picker's market. It was different the first leg up. The whole region caught fire because of Patriot and all of the capital that was coming in. And if you just said James Bay and lithium spodumene and pegmatite, your stock went up. Those days are over. You actually have to deliver now. Even the Patriots of the world have had pullbacks despite spectacular results. And it's because people are dissecting, as they should, a little bit more of what's under the hood. And in Patriots' case, they have the goods. They're going to do great. But there's a lot of other companies that claim to have the next great discovery and all of the Patriot-like, signs. Very few of those are going to succeed, but there's a couple. I mean, I can give you a name if you'd like.
If you would like to, then please go ahead.
Q2 Metals.
Okay.
Q2 Metals. The gentlemen and then the ladies that are working on that project are the same group of people that vended the Corvette property to Patriot, right? And so Neil McCallum of DeRouge Geological Consulting, right? They've done a phenomenal job of just tying up land and securing the best greenstone belts in the region. And now they're rightfully getting to benefit from all of the hard work they put in by being ahead of the crowd. And so I think Q2 Metals, which has 2 rigs turning on its MIA property, it's a 10-kilometer trend. It's got good grade and samples. We're going to see if it's continuous, and we're going to see if the grade holds up when they actually start drilling it. But it's a pretty substantial shareholding of mine, and I think they're going to be successful.
Okay, one more lithium question, and it relates to this region. So I believe that there are a chunk of Australian companies that have come over there. They've got experience in Australia. They're coming here where I think the geology is similar. So do they have any kind of edge with that background?
Absolutely, because look, the North American, especially the retail market, doesn't really have an understanding for these types of deposits as well as the Australian market does. And you see the disconnect sometimes in the buyout offers that a lot of Australian companies are getting with, I don't want to say inferior deposits, but with deposits that are less advanced or have more challenging metallurgy than, say, a Corvette for Patriot, right? And when you see a company get a $1.6 billion takeout offer, and you see that Patriot barely has $1 billion market cap, and this company over here with the offer doesn't even have a resource yet and has some metallurgical issues that, are going to have to get resolved, and maybe they will. It tells you there's a disconnect in understanding between the deposit types. And I think some of that is just a lack of experience. Australia and the folks over there have a deep understanding of how profitable these deposits can be. They're taking advantage of it. There's lithium wars going on right now with buyout offers every week. And, Gina Reinhardt is famously blocking all of, the Australian assets being bought by anybody that's not Australian right now. Whether that's intentional or not, that's how it comes off.
It seems intentional.
It seems intentional, by the way, right?
Yeah, it does.
Yeah. So, yeah.
Okay, very interesting. All right, so lithium, we'll leave lithium there. We'll move over to uranium and see what's going on there. So uranium, we've been talking about it. This is one we've been talking about for years, not just last year. And we've seen prices, as you mentioned, they're on the rise. Is this it? Is this the move up? Are there any setbacks that uranium could have at this point?
I think the only thing that can derail the uranium bull train at this point is another Fukushima-style accident, right? And whether that was an accident, an engineering flaw, call it whatever you want to call it, it was really unfortunate. And, obviously it did what it did to the sector for a prolonged period of time. So I think in this case, all of the stars are lined up. And I think we have a scenario where uranium can overshoot, I say to 200.
Oh, that's what Nick said this morning.
Right? Yeah, in the next 18 to 24 months. There's a group way smarter than I, and then maybe smarter even than Nick. I know Nick's super smart, right? But they came out, and they're typically a conservative group, and they said they think it could overshoot to 300. Neither of those has to happen. If we just get, the sustainable price of 100 to 125, which I think is where the median will be, we're going to do phenomenally well. And the companies that actually have talented management teams that have seen these cycles before and have assets that are real are they're going to go up 5-fold, 10-fold in really short order. So definitely make that list, check it twice, and get exposure.
Yeah. Maybe we talk a little bit more about strategy here, because for people who listen to everyone who was talking about uranium years ago, maybe they have already seen some pretty good gains, and they might be wondering, okay, what are my next steps? Or people right now might be saying, wow, it's already moved. So what do I do?
I am, again, I kind of preface myself and pride myself on being a super simple guy. I am very high risk, very high reward. So I gravitate towards the explorers, right? And as long as that spot price is doing what I think it's going to do, meaning go higher, those explorers, if they have decent results, they're going to provide the most leverage. That's always the case. You have to decide as a speculator in the space what your timeline is, and you have to give yourself the luxury of time to make a mistake, because you might guess wrong. And so give yourself the opportunity to be wrong for not just a month, not just 6 months, maybe a year. I've been wrong before on things for 6 months to a year, and then it turns out to be like the best thing I could have done was sit and wait, right? So you have the tailwinds, you have a rising price, you have the utilities that are coming off the sideline soon. They're going to renew those contracts. They're going to drive that price higher. You have funds buying into it. It's the perfect storm. Make a list and then decide what your risk tolerance is. And that's going to be different for everybody. Somebody else might really like the producers because they want to capture the leverage to a rising price. Neither strategy is wrong. It's just really a personal preference, right?
So tell me about your strategy when it comes to the explorers, because I imagine, and I'm thinking about exit strategy, because I imagine you're not entering these companies thinking, oh, during this bull market, they will produce and, all this stuff will happen. So what are you thinking there?
The very first thing, this is how I was taught, and it's done wonders for me, is speculate on companies that have a share structure that allows for a mistake or two. What I mean by that is, look at if the company is an explorer with 300 million shares outstanding already, and they're just now raising money to go launch an exploration program, it's going to be really hard to capture the kind of price appreciation that a company with maybe 40 million shares outstanding, owned by 7 high net worth individuals, right? is going to give you. The leverage is just different. And so for me, it's all about share structure. Who owns the shares? Does management have skin in the game? At what price does management have skin in the game, right? Is it half-cent shares, or are they actually buying in the market alongside their shareholders? And so all of those things to me are important when I decide who am I going to write a check for. The share structure tells me how a company feels about its shareholders. And if it's a good, solid share structure, if it's high net worth individuals, not too many funds, because the funds are allocating other people's money, right? They're not allocating their own. So it's a lot easier for them to make a mistake with somebody else's money than it is me making one with my own. All of that is important to me. So share structure first, before assets and before management, and then management.
Perfect. All right. So I have not forgotten about gold. I will ask you about gold before we're done. But lithium and uranium, they're definitely on the energy side. And what I hear from a lot of people who are interested in one part of the energy sector is that they're actually interested in all of it. So including oil and gas, maybe coal, things like that. So in energy, are you spreading yourself around in that way as well? Or are you keeping it in the lithium and uranium?
For me, lithium and uranium, because I actually really understand those markets for whatever reason, right? I don't pride myself an expert in those markets, but I really understand them, and I got a really good handle on the management teams in the regions that I'm actually investing capital in. And so good access to them, a really good understanding of their business model, understand the region well. Jurisdiction is becoming key more and more every day. You're seeing companies that are having their projects nationalized on a whim, right? You have a situation with a copper company in Panama, and the stock's down 50% in one day, and you wake up and 50% of your capital is gone because the government decided to make a decision that wasn't beneficial to the shareholders. And so I want good jurisdictions, I want exploration upside, I want good share structures, and I want management teams that know what they're doing and what they're trying to do, and they have a history of success in that. So yes, okay. I'm keeping it to those two.
Okay.
Make sense
no, it makes sense. It does make sense. So just going back to gold, so you mentioned now is the time, right? And you talked a little bit about your reasons for thinking that. Anything you would add to the gold story, things you want investors to know about why they really should start to consider it right now?
You know, the most impressive thing to me is the Fed has, mortgage rates essentially, right? They've manipulated those up to about 8%. You have 5% interest rates. You have a Fed that says, I don't believe it, but the Fed says it's going to continue to be very hawkish. I think the market will force the Fed's hand eventually. That may be a year away, right? Despite all of that, and a dollar index that recently hit 107, gold is near $2,000 and within, 10% of its all-time high. That is as impressive and resilient to me as I've seen in the gold space in quite some time, and is why this year I'm actually happy to be here and talking about gold and not just lithium and uranium, because last year was a different story. The dollar index was somewhere around between 94 and 98. Gold couldn't catch a bid, and that told me it wasn't time. Opposite rings true today, right? Dollar index near 107, and here gold is wanting to break 2,000 again. It did recently, and it wants to break all-time highs. And that's what it's going to take to get the retail segment back speculating and get that capital back into space.
Yeah, that is what I keep hearing for sure. Okay, so as we're finishing up, maybe a fun question. And I think it will be fun with you because I have a feeling you're gonna have a different answer than
most, as you typically do with stuff.
Yeah, so we'll see. So the question is, if you had to choose an asset to hold for 5 years and you're looking for the biggest appreciation, what would you choose? It can be a commodity, it doesn't have to.
I have to hold it for the entire 5 years?
Yeah, for the purposes of this, yes.
Copper.
Copper? We didn't even talk about copper.
Copper. Let me explain why.
Okay.
So I think lithium has a great, set of fundamentals. I think we're near a bottom, but it's going to continue to be volatile. And I would hate to hold it for 5 years and I hold it through another consolidation, right? With uranium markets are so volatile and violent to the upside that we could get that $200 spot price within the next 18 to 24 months and then pull back to that $125 level and then just settle there, and then the market gets bored and the capital leaves because it's bored. And that might happen with my five-year matures, right?
Yeah.
Copper has the best midterm fundamentals I have seen in quite some time. The way uranium did 3 years ago, the way lithium did to me 7 years ago, that's copper to me right now. I can go to sleep today and I have a lot of copper exposure that I've added over the past year.
Okay.
copper would be the one. I think in 5 years we wake up, copper is at least double today's price.
Okay, we did get a different answer than everybody else, so that's perfect.
You're welcome.
Thank you. Okay. As we're finishing up, any final advice for investors right now? We're heading into the end of the year. New Year is coming pretty soon. What should investors know?
Pick your sector, pick your management teams, dissect share structures, ask questions. This is the bottom, folks, for a lot of these commodities. We have a lithium bull market that's about to reheat. We have a uranium bull market that's shooting. We have a gold bull market that's about to restart. Silver will catch up eventually, as it always does. Copper might be a year and a half away, but that's coming. It's a beautiful time in the commodity space, and it might get really tough in the overall indices given, some of the macro factors at play right now. So it's a great time to really get to know the different sectors and make your list and start adding to it.
Okay, all right. This is a good place to wrap it up. Thank you so much for coming on to talk about all the various different commodities that I have not been speaking with to everyone else. Thank you very much.
Always a pleasure, Charlotte. Thank you for having me.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Gerardo Del Real. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.